All right, the market continued this run of like really small ranges, small volume days. I don't know if it's anticipating tomorrow's PCE. I don't think tomorrow's PCE was really that big of a market moving deal, but it's still we had that big move after the Nvidia earnings, and we really haven't like built on it. In fact, we've been kind of stuck inside of that range of after the market opened on Thursday. The rest of that day's range, we're still kind of stuck inside of it. We haven't broken into that gap yet, but you can see some signs that it appears like we most likely are. So I'm going to kind of show you what some of those signs are and what some of the rotation looks like among the different sectors. A lot of chatter about the market broadening and the sector rotation. So I'm going to talk about that. I spent a whole hour on it today in our premium technical analysis class for our subscribers. About how, what's a good broadening versus what is a broadening that typically leads to a decline, a pullback, right? Whether it's a small pullback and we also talked about the fact that we haven't even had a small pullback for a very lengthy amount of time. In fact, for like up to the 2% pullbacks for like a long time. This is one of the bigger ones without a 2% pullback that we've had for a very long time in terms of the size of the rally. So I'm going to break all that down, the moves that we're seeing today, which are kind of interesting, even despite the fact that it was pretty minimal. And then our trade ideas, a stock is in an area that we don't trade very often, but it's looking like after a year of decline, like it's starting that there's some green shoots coming up. So we're going to talk about how to trade those green shoots. Let's go ahead and get started. All right, today is Wednesday, February the 28th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook Live video, where I take a look at all the trades we've done in these videos to see whether we should stay in them, let them go, get out of them or not. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up that tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. It's a big deal for us. That's why we always ask. So thank you very much for those who like this day in and day out. Our goal is to get to 100. So if you don't click those likes, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, now let's take a look at what's going on with the S&P 500, like we always do with the market forecast indicator. A little bit of a down day. Again, very, very small range. 4 days in a row of just no move whatsoever. The intermediate line has rallied that entire time, including today. Still above the 90th percentile, still rising, though obviously can't rise forever here. It only goes up to, this is a percentile basis, so it can only get to the 99 level. Eventually it will turn slightly lower, but being above 80 especially is very bullish, and especially being above its market sentiment, which is still falling, but it's still above 82. In fact, it's still above 85. So we're still okay, like still very strong trend, and still the short-term sentiment doesn't look like it is. I mean, look at all these other near-term peaks or bottoms that don't get into the red. Aside from this one here, this was probably the one near-term decline that had the most potential of ending this run, but it didn't. Right, we had a strong momentum rally right off the bat the very next day, getting up to extreme highs, and the near-term line did too the next day after that, and so that really helps that dip hold, right, kind of like a bull tag, but didn't close below the moving average. At least you got the light pink shading. So that was probably the closest. All these other instances where the near-term line just dips in the bearish territory, we just bounce right back up off of that. And as of right now, that's what this move is looking like. We are a little bit below 2.5%, but that's okay. We haven't crossed the 0 level yet, which obviously would happen when you get the bull tag. So everything is still fine from that perspective. You look at the NASDAQ 100, same thing, still strongly bullish, near-term decline, no big deal. Right, the Dow Jones Industrial Average, same thing. Intermediate line is up above 90 now, almost above 90, above the market sentiment. Near-term decline to nice levels. That's not very deep. We did have a weak momentum line, but that's okay. The near-term line so far has not followed suit. Your Russell looks a little different because it never did pull back. It's actually been on the near-term rally. that now is over with, right? We have, or at least not over with. It's not in the reversal zone anymore. We dipped out of the reversal zone, and we've actually dipped a little bit below the intermediate line, which today crossed above the 80th percentile. So both those lines crossed each other, and they both crossed the 80th percentile today. So a little bit of a sign of weakness on a very short-term basis. Your momentum line also dipped to extreme lows. It does that a lot more often on the Russell. It's a more volatile index. So that's a little bit of a sign of weakness. The market sentiment line is, your intermediate line still is above market sentiment, so that's good, and it's above 80. The market sentiment line is still falling, and it's actually outside of the reversal zone, unlike all the other indexes. So we'll see if we can make another attempt at breaking through this kind of 2,000 level and staying there this time. We haven't been able to the last few times that we've been up in this area. We've had pretty significant drops here after the first instance, and then here after the second instance. So not as big of a move to get there the third time, though. Another gap to get there, and we'll see. We've already started to fill in that gap a little bit. All right, let's take a look at the market forecast and some other major asset classes. The 10-year yield was down today, 4 basis points, but still okay. We're still bullish, dark green shading the green line. The market sentiment line still rising in bearish territory, but it's still rising. Intermediate line still well above it. The near-term line is below intermediate, but that's okay when it's in the reversal zone, right? And you're still actually in bullish territory. This could be a bearish peak on the near-term line. Because again, we came out of bearish territory here, so this could be a pretty bearish peak if we follow through on this tomorrow. If we bounce back up tomorrow and the near-term line jumps up above 80, then we're okay. So that's something to keep an eye on. That's the latter is what I expect will happen. The dollar, you can see, had a good day today, but came off of its highs, and you can see too that. That the intermediate line is actually down slightly below the 60th percentile now, even though short-term it's still above market sentiment and short-term sentiment is still improving. So the near-term line is still below intermediate line, so we're still in this decline, but you can kind of see, it's trying to form a little bit of a bottom here. And then finally, crude oil was down a little bit today, but it still has a strong bullish posture that's well above its market sentiment, that's also rising. It's actually outside of bearish territory now, up at the 41st percentile. Its near-term line's also in bullish territory, but not quite yet above the upper reversal zone. But we'll see, right? At least the trends are still there for all those major assets. Bitcoin, of course, has been enjoying a strong bullish move. It had a overbought cluster yesterday. The intermediate line still up above the 90th percentile. A little bit of a long upper shadow today. But you are above the 60,000 mark. The near-term line's also at bullish levels. Market sentiment still at bullish levels. You are further up above the moving average right now at 30%, more than we've been on any other occasion in the past year. If I were to go out 5 years, it's not quite there, but it's still pretty strong. You can see some of these other instances where we got pretty significantly above, and the highest we got was back over here in 2021. So it is high. 30% is high. If you follow my cursor all the way along to the left, it is high here, but that doesn't necessarily mean that we have to drop. Let's kind of see how this momentum shakes out with this intermediate line. Still, this overbought cluster, still relatively close to the beginning of this intermediate. So you can see a risk appetite in general, this pretty strong right now across the board and across different asset classes. Emerging markets has been, an area of the market that has not been as strong. Its intermediate line has got into the reversal zone, but today was a pretty big drop. The near-term line, though, momentum line's oversold. The near-term line is down. This is a bullish intermediate confirmation signal, so this is a signal that we would expect actually will bounce going into tomorrow. And then developed markets are kind of similar, but not so extreme. Right? Strong bullish posture, a little bit of a near-term decline, but like the S&P, not necessarily too bearish of an intermediate decline there. Let's take a look at the weekly chart for the S&P 500. We're still looking pretty good on this week. Still got a higher close, but we don't have a higher high yet. So something to watch for into tomorrow and Friday. to help really solidify the bullishness of this trend. And a lower high would suggest that maybe next week we get a lower close. And that would be, either a transition candle or a sign that a transition is coming soon. 3 green arrow chart now is not 3 green arrows on the S&P or the Dow. You got a red arrow on the momentum, MACD, excuse me. We never did get the 3 green arrows on the Qs because of the MACD. And then the Russell still has 3 green arrows. So we're still okay across most of these. At least we don't have 3 reds anywhere. We're still above the 8-day moving average on the S&P. It's still above its moving average. MACD is still above its moving average. There's no clear breakdown here. We're definitely not breaking below the 17 yet, though we are way up above the 200 there. So a break of the 30 really puts in, really puts that move to the 200. Like that would be a threat that we could drop and fill in that gap. That's what we do when you break the 200. And this is, we're higher now. The MACD is higher now than it was over there. So if and when we ever do break the 17 and then subsequently the 30, then you can see we're pretty bullish here. Going out to even 10 years, you can kind of see here, even 2018, we weren't this far. The 30-day wasn't this far above the 200, and neither was pre-COVID. 2021 was a kind of that reopening trade. Inflation really started to kick in gear. So pretty big move there, but outside of that, normal market environment, especially now considering where rates are, this is a more normal market environment. This is a pretty high level. So again, any break, if we ever get a break of the 30, and we will at some point, we never have all the time gone above 30-day moving average without ever breaking it. So that will happen at some point. The question, of course, will be when. And when it does, because it's such a big gap here, it puts a correction. You fill in those big gaps with large pullbacks, if not corrections. So we don't really necessarily want to be that bullish. And you can see even the weekly chart is, the weekly levels here. Let me go back to the regular MACD and then go back to the weekly. You can see we're also pretty high here. Again, higher than we were pre-COVID. And again, opens up a big gap down towards the 200-week moving average. And again, filling in that gap is a correction. Going down to the 50-day is just a pullback. But getting below the 50 towards the 200 now, we're looking at correction. Of course, getting below the 200 and staying there is what constitutes a bear market. So let's look at some of the other oscillators here on the DMI first. We're still pretty bullish, well above 30, but we're not below 20 in the negative. Again, goes to show just kind of how strange this market is. The Ichimoku cloud, this trend strength indicator, still above 18.5. Still very strong, but we're also still above the green line and definitely still above the blue. Again, breaking the green line puts in the gap here to the cloud, and then breaking into the cloud suggests that you're going to make your way through it. So we're not at that point, obviously, yet, but you can see the different stages, and we're still okay for now. The RSI and the CCI are also still at bullish levels above 60. This is one of the longest periods for us to be above 60 that we've been on. There are brief little drops below it, but for the most part, that's a long period, a lot longer above 60 than what we saw over here. When you count up all the days of 60 plus readings. Remember, the weekly is, also got higher than we did. We only had one day above 70. It was barely above 70. We've been above 70 now for multiple weeks, and we got up to above 75 last week, and we're still above 100 on the weekly chart down there. The Bollinger Bands and the Keltner channels, we're still in the upper quartile of the bandwidth. The bandwidth does appear to be peaking here and moving potentially back towards, so we're losing a little bit of momentum, but nothing. We're not close to bearish momentum, nor are we close yet to getting red dots, which is what happens when the bandwidth shrinks inside the Keltner channel. So we're still okay. We're still riding a nice little trend as long as it will take us, right? That's the nice thing about these parabolic moves, is they'll just go as long as they take us. You can see the threat, the short-term threat is filling in that gap, and I still believe that that's a likelihood, a higher probability by the end of, at least starting to fill it in by the end of this week. And we'll see by tomorrow what kind of significance the PCE has. We still haven't gotten a new high, so that means, we're moving our way down on that green the green line on the Arun indicator. We're already back to 0 on the red line. Once this comes off, then the next low is going to be there, and then the next low is going to be up to here, right? And then now we're looking at the low here, and then we move up to this. So the red line will move up at that point there too. So you can kind of see that how close, and how much this can drop again to below 5% and get pretty low once that low point starts moving up without a new high point there. You see that reflected as well. I mean, it's pretty much a lack of volatility. Volume has been tapering off here, and today's was low. The ATR is falling fast. It's back below 85%. Remember, getting below 1 is a pretty big deal, but getting below like this 80% mark is pretty extreme. So the ranges are really falling fast, as well as the volatility. Though volatility did end up today up 3%, we're holding this 90% mark for support. The VVIX is sitting right around extreme lows, as the VIX itself is still holding average values for a support. In this case, a 50-day average value for a support, and hasn't been able to break through that, and is potentially forming a higher low point to bounce off of. And again, that's how close we are to the 200-day, and getting above the 200-day is a significant change in volatility. That's like a new regime. So we've, the gap between the 50 and the 200 is a lot smaller now than it was over here when we broke through and had our intermediate pullback back here. Actually started on July 31st. So this is when the intermediate pullback started, but we didn't get above the 200 day until towards the end of that run, when things got a lot more volatile. You can see this kind of move right here would already get you above it because it's so low. In fact, it's the 200-day average is well below 15, easily below 15 now. All right, now let's take a look at what's driving a lot of this price action here. So let's look at the asset class comparison chart. As we saw a little bit of it today with the market forecast, you can see U.S. equity is still really dominating pretty much everything else right now, with the weakness in the dollar, weakness in commodities, weakness in yields over the past 3 months. But again, let's look at today first, February 28th. You can see again, bonds were up pretty big, and as well as real estate, interestingly enough. So yields were down again, big in context. That's not a big number, 0.62%, but obviously it's a bigger move relative to others. IWM and the Qs both were down pretty big, though S&P was only down 0.13%. So it kind of goes to show the mega caps and the smallest of the small caps were down more, and those kind of mid caps still held ground. Emerging markets, of course, getting the biggest move lower. A little bit of strength in the dollar, but nothing too significant. Nothing that would necessarily cause a big move higher. You can see, like we came off the highs, and we're still below these kind of short-term moving averages on the dollar. Though the MACD and histogram is rising, so it looks like it's trying to make its way up. Same thing with the 10-year yield. The MACD's actually dropped below its moving average. We're still above the 10-year here. And then, of course, commodities are basing, right? And we're, break above that 50. You got a big gap between the 50 and the 200, and it's just kind of waiting to see if it can actually break above that 50-day. And that's going to depend largely on crude oil breaking out above $80 and making its way higher, which it looks like it's trying to do. It's kind of holding a lot of resistance here, but it's also not breaking down from that resistance either. So you're getting a lot of pressure up here at that 80 mark. And obviously probably a break above that, which would be above the 200-day moving average, up above the value area, would really kind of send it, give it a little bit of escape velocity, so to speak. And that would obviously mean that commodities would start to fill in its gap. This ETF of commodities would start to fill in its gap between the 50 and the 200-day moving average itself. So we're not there yet. And obviously, if that ever were to happen, that would have an impact on our risk appetite. The breadth is still really bad. Like, I know there's a lot of chatter about how, the breadth, we're broadening out and this move is more than Magnificent Seven. That is correct in that this move has a lot less influence in the Magnificent Seven. Those stocks are really bifurcated right now. There's weakness in Microsoft, Apple, Google. Down here, Cisco got an oversold cluster again. Adobe, all those stocks are showing, bearish patterns on their market forecast. Tesla looks like it's trying to get a bull tag going, but it can't follow through yet. The rest of these, and it's really led by NVIDIA, are doing pretty well. Dark green shading and green line, way better than the two bigger companies here, and Google as well. So Meta, NVIDIA, Broadcom, Netflix even, and AMD and Amazon, all still above moving averages. So you have a good chunk of the Magnificent Seven when you're looking at just those 7 companies. NVIDIA, Amazon, Meta still doing okay, but Tesla is kind of trying to do okay, but not really. And then Apple, Google, and Microsoft are not doing okay. So we've seen this before multiple times when the markets run out of their intermediate rallies. Towards the end of those rallies, parts of the Magnificent Seven, usually the parts that aren't NVIDIA, start to break down. And then NVIDIA eventually sparks the breakdown in the entire market once it starts to slow itself down and break its moving average, which of course right now it's nowhere close to doing that, right? NVIDIA is still well above moving averages. They are well above, it's also well above this 200-day, but you can start to see, again, little signs of divergence showing up there on the MACD. And there's no volume. We moved up so fast that there's very little support now. And the biggest ledge of volume now is pretty much all the way down to where, right around 500, which is where the 200-day moving average will be if we were to test that level. Because you can see how fast it's rising down there. So until you start to see really any weakness in NVIDIA, then the broader market will still be kind of grinding with no breadth, no volume. You can see the money flow broke below 50, barely, but it broke below 50 there, so not as strong anymore as it used to be. When you look at some of these other breadth indicators over here, let's see here, the number of stocks above the 50-day moving average, slightly above, but no real big breakout like you like to see when you're breaking above the moving average and turning it higher. So still don't have a really significant breakout there. The number of stocks above the 200-day is actually a little bit higher, but again, still nothing too major. There's not a lot of momentum down there for that. So the ratio is still kind of hanging out here, or right around its moving average. The skew is also, it's up a little today, back above 145, but it's still below its moving average, which usually is, kind of a sign of weakness for the markets and markets looking for protection. The number of stocks at new highs are down slightly below its moving average. That's not too significant yet for that market, but again, this doesn't look like a strong breadth at all. It's very, very weak. You saw that McClellan oscillator. It's very, very weak. And so until we get, one way or the other, until we see this break out either below minus 35 or above 35, then we're just kind of in this grind mode. Probably you would expect the below minus 35 considering everything we've been talking about. But until that happens, just ride this convergence move up, right? It might not go up very fast, as fast as like Bitcoin or some other individual names, but as long as it's grinding up, then we continue to ride it until those signs of weakness that I just showed you there start to show up. Let's take a look at the sector moves here today. So we'll look at the sector comparison chart. You can see financials, industrials, and healthcare now are your best 3 performers, outpacing XLK and XLC and XLY over the past 3 months. So an interesting change. A rotation, I tweeted that out today, the rotation is changing into some of these other areas that are not so cyclical. Look, in fact, XLK and XLC were our worst performers today, and they have been the best. And you see that rotation showing up here. Again, this is another sign that things are rotating out of favor as your XLC and XLK are in the lagging category. Financials, materials, industrials, healthcare are all in the leading category, and you can see the real significant improvement in utilities, real estate, and staples moving up with healthcare in the improving category, working their way towards. So this is the typical rotation when we're close to the end of an intermediate rally. These stocks start to take hold towards the end of that rally and lead the market, and your market leadership which is the, should be your market leadership because of how big they are, aren't leading and they're in fact lagging. All right, we'll take a look at our trade idea of the day, which is on one of these industrial names. It's actually been doing a lot better. It's been lagging Albemarle. You can see it's been really lagging the market. When you look at its market forecast, dark pink shading and a red line for most of the past year, a few little bullish trends. But here we are starting potentially a new bullish trend, up 11% above the moving average. So it's a strong move. It's not like we're just barely above it like this one over here where we couldn't really get going. So a strong move higher. We got dark pink shading, or excuse me, dark green shading, and a green line. You can see the weekly chart. We have a green arrow again. We have very, very low PPO, but we're diverging with higher lows here and the lower lows. So a chance this may be the low point for that stock. Looking at the 3 green arrows, you can see that we are above the 50-day moving average and the point of control. MACD is strongly positive. Stochastics is moving higher. Very, very good oscillators. Very good patterns on these oscillators. All breakout patterns. Almost above 30, below 20 on the negative. So the ADX is starting to roll up again. Looking at the Ichimoku cloud, we are almost above the cloud. That would be a big breakout. We didn't quite get above it over there, and that's kind of where we ended. But we're just starting the trend now, and we're already almost above it. And the cloud's not as big as it was over here. So there's a good chance we can really break through there. The RSI and the CCI are up to bullish levels. The RSI above 60, the CCI above 200. So very strong levels there, breaking up above the upper Bollinger Band. And was trading above the upper Keltner channel at the highs of the day today. But you can see staying above the upper band. The band's widening out. Hasn't broken its outside the Keltner channel yet, but you can see that positive momentum. You expect to probably get green dots in the next day or two there. So, really good opportunity here for this to really get going. So I got a little bit more aggressive on this trade and was looking for a long call vertical out in April. But instead of going all the way to the low deltas, low 20s, I went to or the mid 30s, which is a little bit more conservative. I went in between. So I sold the 150, bought the 145. That gives me my typical $500 of risk. Let me get rid of that trade. It gives me my typical $500 of risk. And you can see a 3-to-1 reward to risk ratio with quite a bit of flexibility built in case the timing isn't exactly right now. I've got some flexibility of time and movement before we the max gain is outside the window of probability for achieving that return. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Follow me on Twitter and Facebook, and like us there as well. Join our website, again, for free at marketscholars.com. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.